Welcome to The Explainer. Now, if you're an income investor, you've probably been taught to look for one thing, stability. A long history of paying out dividends. But what if that very strategy, the one that's supposed to be the bedrock of conservative investing, is actually a trap? Today, we're diving into why the rise of AI is forcing what you might call a dividend rebirth. We're going to build a whole new playbook for finding truly safe, growing income in a world that is just changing faster than ever.
Okay, let's just dive right into this because this statement, wow, it's not just a bold claim, it's a direct challenge to decades of investment wisdom. The dividend kings, these are the absolute royalty of the stock market. We're talking about companies that have increased their dividend for over 50 years in a row. They're supposed to be the safest of the safe, right? Well, this quote says that almost half of them could be ticking time bombs. So what on earth is going on here?
To really get what this dividend rebirth is all about, we first have to understand the market forces that are pushing investors toward dividends in the first place. Investors don't make decisions in a vacuum. And right now, the whole environment is making a lot of people, well, pretty nervous.
Now check this out. What's so interesting about this slide is the story it tells about price. The price-to-earnings ratio, it's a classic yardstick for how expensive the market is. And historically, investors have paid about $16 for every $1 of a company's earnings. Makes sense. But today, that number is over $24. That is a 50% premium over the average. A lot of that is driven by a handful of giant tech stocks, sure. But when valuations get this stretched, it means there's just very little room for error. The potential downside starts to feel a whole lot bigger than the potential upside.
So when those high-flying growth stocks feel this expensive, what do people do? They seek refuge. They run to what they think are safe harbors, companies that pay a nice, steady dividend. The logic is pretty simple. Hey, even if the stock price goes nowhere, at least I'm getting paid, right? It feels like a guaranteed return. But what if that safe harbor is actually built on sinking sand? That feeling of safety, well, it's often a really dangerous illusion.
So this is the crucial point. This big rush to safety has a really dark side. See, many of these seemingly cheap, high-yield dividend stocks are what Wall Street pros call a value trap. And that's a term you absolutely need to understand because it's where investment portfolios go to die. Seriously, this is where you find those tempting 8, 9, 10% yields that promise you the world but end up costing you a fortune in lost money.
Think of it this way. A value trap is a stock that looks cheap for a very, very good reason. Its business is in terminal decline. Yeah, it might be earning $1 per share today, but it's on a clear path to earning 50 cents, then a quarter, and then nothing. That juicy dividend you're seeing isn't a sign of health at all. It's a promise based on past glory, a promise the company probably can't keep.
And this is the critical question, isn't it? We're taught that a long track record means stability. A company that's paid dividends for 50 years feels as solid as a rock. How can that possibly be a risk? Well, the answer lies in a really powerful cautionary tale about what happens when a company makes promises its business can no longer keep. And this story just brilliantly illustrates the danger. Studebaker was a household name, an industrial giant, but its car business was failing. So, to keep workers happy, without spending cash they just didn't have, they made bigger and bigger pension promises that were due years and years in the future. They were just kicking the can down the road until, well, there was no road left. When the company finally collapsed, those pension promises just vanished. A high dividend from a company with a dying business is the exact same kind of unsustainable promise. It's a huge liability that needs a healthy cash-generating business to support it. Okay, so how do you separate the durable companies from the ones that are doomed? How do you avoid the next Studebaker? You have to look past the glossy paint job of reported earnings and actually pop the hood to check the engine itself. And that engine is something called free cash flow.
Most investors focus on net income, or earnings per share, but that number can be massaged with all sorts of accounting tricks, like depreciation schedules or how they value inventory. The number you should be looking at is free cash flow, or FCF. It's the actual, cold, hard cash a business generates after paying for everything it needs to operate and grow. It's the money that's truly free to be returned to shareholders.
And the best part is, you don't need a finance degree to find this stuff. It's a really simple calculation, right from the company's financial statements. You start with cash flow from operations. That's the cash the core business brings in. Then you subtract capital expenditures, or CapEx. That's the money the company has to reinvest in itself, to buy new machinery or build new factories. What's left over? That's the real profit, the free cash flow. And this is just a perfect example of why this matters so much. Back in 2014, if you only looked at Amazon's income statement, you would have seen a net loss. You might have thought, wow, this company is failing. But if you peeked at their cash flow statement, you'd see they actually generated almost $6 billion in cash. So why the difference? Well, they were investing every spare dollar into building fulfillment centers and data centers, huge capital expenditures. The accounting rules saw a loss, but the cash flow told the real story. This was a healthy, rapidly growing cash machine that was busy building an empire.
Okay, so understanding cash flow is the key to avoiding yesterday's traps. Now let's see why it's also the key to surviving tomorrow's revolution. Because this focus on cash becomes absolutely critically important when we factor in the biggest technological shift of our generation, artificial intelligence. The numbers here are just staggering. Over $2.5 trillion are expected to be spent on AI in just a few years. Now, first-level thinking says, wow, I should invest in AI companies. But as savvy investors, we have to use some second-level thinking. We have to ask the most important question there is. And then what? What does it actually take to build this AI future? And the "and then what" is this. AI isn't just software living in the cloud. It's a business of atoms, not just bits. To power this revolution, you need a physical build-out on an industrial scale. We're talking about vast data centers, specialized chip plants that cost billions to build, and a mind-boggling demand for electricity. I mean, Microsoft is literally bringing a nuclear power plant back online just to get enough juice. All of this requires breathtaking amounts of CapEx, which means only companies with massive, real, recurring free cash flow can even afford to compete, let alone win.
And this brings us full circle. We started with a pricey market pushing people toward the fake safety of high-yield stocks. We uncovered the danger of the value trap and found our antidote, free cash flow. And now we see that the AI revolution is basically a capital-intensive war that will be won by the companies with the deepest pockets. So, it's time to combine all these ideas into a new playbook for 2026 and beyond.
So here it is, the framework for the new dividend aristocrat. First, just forget about the yield. Focus on the free cash flow payout ratio. How much of the company's actual cash is being used to pay the dividend? If it's below 60%, that is a huge margin of safety. Second, check the debt. A clean balance sheet is a strategic weapon. It gives you the flexibility to invest heavily in AI without asking anyone for permission. Third, analyze for growth. Is the company just a melting ice cube, paying out everything it has, or is it investing its extra cash to actually grow the business? And finally, embrace creative destruction. Don't look for companies that are just trying to survive AI. Look for the ones that are using it as a weapon to get even stronger. Here's what you should really take away from all this. The very nature of a safe investment is changing right before our eyes. The old rules, a long dividend history and a low PE ratio, they're just not enough anymore. The true dividend aristocrats of 2026 and beyond will be the companies with the financial firepower, the free cash flow, to not just withstand the AI revolution, but to lead it. They're the ones mastering disruption, not just surviving it. So you have to ask yourself, is my portfolio built to just survive this new era, or is it built to master it?